Hello everybody, this is AK. I'm back. So in many videos in the past, I have said that when we are investing in businesses, we want to keep an eye on its balance sheet, right? Especially as investors for income, because I've said before that if a business doesn't have a strong balance sheet and if something should go wrong, like during the pandemic, the business might have to stop paying dividends, right? Or cut dividends or reduce the payout. And if the balance sheet is really weak, then it might even have to go to shareholders and ask for more money, right? So during the pandemics, some of my investments stopped paying dividends, like Centurion Corporation, and I've shared this in some videos before, and that's one reason why I decided to cut my investment, reduce exposure to that company substantially, and instead use the funds to invest in DBS, OCBC, and UOB. And I'm very happy that I did that, because also the primary consideration for me was, of course, the balance sheet strength and how DBS, OCBC, and UOB were able to pay dividends during the pandemic, right? While Centurion couldn't. And so keep an eye on the balance sheet of a company if we're interested in investing in it. And of course, if we are already invested in it, we should continue to monitor the strength of its balance sheet, right? Just to assure ourselves that dividends will continue to be paid. Then in a couple of recent videos, I said that interest rates are staying higher for longer. So for businesses with weaker balance sheets, for businesses which depend on borrowings in order to continue operating, this is not good news, right? Because then what happens is their cost of doing business would continue to stay high. They have to pay a lot more in interest expense for their borrowings. And so I say, if you are investing in risk assets like REITs, we have to again examine their loan book, their loans, and see how much of it is on fixed rates and how much of it is floating. And if it has a big portion which is on floating rates, then we want to be very careful. And what do I mean by careful? And that is, if we are not invested yet, we might think twice about investing in the REIT. And if we are already invested in the REITs, then we want to see whether they are able to increase the proportion of fixed interest rates loans going forward, and whether they are able to reduce gearing one way or another, so that their cost of doing business can be less impacted negatively. And of course, this is not just about real estate investment trust, because we can also be investing directly in properties, right? And this was something I've touched on before in some videos in the past, and that is, we shouldn't be overly optimistic and don't be overly leveraged and throw everything in, including the kitchen sink, in any investment, because Asians seem to have a love affair with investing in properties. And I mean, it's quite normal, even like Hong Kong, China, Singapore, wherever. People always think that investing in property is very safe, and the only direction for property prices is always up, and it will never go down. And Singapore is in a nice place right now, a sweet spot when it comes to property investment. It is quite stable thanks to a strong Sing dollar, a stable government, and but it has not always been the case, right? So we want to temper optimism and have a look at our own balance sheet, personal balance sheet, and make sure that if things should go wrong, we would be able to live our life as per normal, and we would not be too adversely impacted, right? Stress test our own balance sheet. So, for example, if we were to lose our jobs, would we still be able to service the loans? And if something bad were to happen and we might have a major expense unforeseen, and we might be like $100,000 down, for example, which happened to someone I know, who had to pay for the father's hospitalization bill, and he was down and there was a big hole in his bank account. And if something like this were to happen, would we still be able to live our life normally, or would we be in distress? That kind of thing. That's why in videos I made in the past, I say it's important to have an emergency fund. In case something bad were to happen, we have money that we can draw upon. And don't be 100% invested in the stock market, for example, or 100% in the property market, for example. That's because that when times are bad, and that's when bad things might happen to us, we might have to liquidate our investments at low prices, right, and have to realize big losses, right? So it's good to temper our optimism and be aware that things could go wrong, right? So I read in the news, for example, this Chinese tycoon who had snapped up mansions and offices in Hong Kong and London now faces demands from banks to repay more than 200 million US dollars of loans, which he and his family have provided personal guarantees. Right, so there's some liquidity crunch, and he did say that there's ongoing downturn in some markets, worldwide, and we know that in the UK and in Hong Kong things are not in a good place. And now they say they have 14 days from the date of the REIT to satisfy the bank's claims or indicate to the court whether they would contest the proceedings or make an admission, right? So, we can be very confident about our future, but it's important to stress test and see whether we could really ride out the storm if something bad were to happen to us. So this isn't a very happy video, but I think it's an important one to make, because I've been making videos to say what happiness, bank stocks are going up, etc., etc., and people might think that it's okay to throw caution to the wind because Singapore could do no wrong, nothing could go wrong, right? So if AK could think about what could go wrong, so can you. Bye bye.